today's topic is basics of market profile. We covered part one, and this is where we stopped, where I promised that I will explore my trading method with you. So what we are going to do today is we are going to go through my method, my approach, the way I look at things, the way complete trading framework will help you look at markets, all those things. And in the last session, or well, what is going to happen in the last session, I will reveal once this session is over, right? So my approach or the CTF way, okay, that is what we are going to learn today. Okay, so correct way to use market profile. Now obviously, there cannot be just one way to do things. Okay, you cannot say that there is just one single way in which you can use a particular tool, you can do technical analysis, you can study and analyze the markets. It's simply not true. In fact, I would go ahead and say that there are as many ways to analyze the markets as there are number of traders. So millions and millions of traders are trading, and everyone is different. Like every human being is different, so every trader is different, and every trader's way of looking at the market, every trader's way of perceiving the information from the market is different. So if that is true, then why do you need a framework, or then why am I saying that there is one correct way of looking at market profile? Well, my objective here is to first share how I do it, and then share what are the advantages of doing it this particular way. So you need to choose based on those advantages whether you are going to look at market profile the way I am suggesting or not, right? And if you like it, then definitely it's going to change your life, that I can promise. And if you don't like it, you are free to keep searching for the best trading method, framework, whatever you are looking for, so that you can trade markets profitably and with peace of mind. All right, so the correct way to use market profile is to look to improve your market understanding. All right, now everyone, whether it's a beginner or an experienced trader, has some level of market understanding, and it can always be improved. So I use market profile to improve my market understanding. Was it always the case? No. When I came across market profile for the first time, I was looking for the same thing. I was looking for a trade setups, and I was saying, okay, if there is a poor high, it will be revisited, or there is a failed auction, shall I jump onto it straight away or wait for confirmation? And how can I find a trend day so that I can make all the money in the world in just one trading session, especially if that trend day is on one of the expiry day? So then I can buy an out of the money call or put and make tons of money and solve all of my trading problems. So I have been doing that long back. Now I have understood the correct way to look at markets, and that is to first improve our market understanding. And there is no better tool, guys. All right, there is no better tool. Second way I use market profile is to segregate time frames. Now many a times there is a big confusion about time frames. People believe that the 30-minute chart, 1 hour chart that they are plotting is their time frame. No, your time frame is how long you're going to hold your trade. So Warren Buffett has infinite time frame because he's going to hold his holdings forever, his stocks forever. He's not looking to sell. But if you look at George Soros, if you look at other traders who are quick on their feet and they want to get in and out of trades, then their holding time frame is less. If you're doing it intraday, then your holding time frame is intraday. If you're doing it over 3-4 days, your holding time frame may be short swing time frame. So on and so forth. So you need to distinguish between these time frames, because if there are a lot of intraday traders and they are trying to do something, we all know that they will be exiting the market by end of day. So if they are going to exit their markets, then their buying or their selling is temporary. It's not permanent. or it's not going to be there for a long time. Its effect is not going to be there for a long time. On the other hand, if the market tanks 20% and investors flood to the markets, their buying is not there for 1 week or 2 weeks. They are going to stay invested for years. So their buying has a lot of staying power, whereas intraday traders are going to exit by the end of the day. Look at scalpers, they are there for a few minutes, if not less than that. So this distinction is very, very important, because different holding periods will have different impact on the markets. And God forbid, if you are a scalper or an intraday trader and you end up fighting a longer term holding interval like an investor or long swing time frame, you will be paying a steep price for that. And if your trading is not going well and you're struggling in your trading, understand that you are not able to first identify or differentiate between time frames. That is a very big issue. You need to learn to monitor trader behavior. All right, so many times traders get hooked onto price patterns. Why do traders get hooked onto price patterns? Why every other mentor on YouTube and Facebook and Twitter and everywhere is trying to highlight price patterns that repeat, that work, the setups, the rules? Why all those things are highlighted instead of focusing on how a trader behaves in different situations? Because identifying this is easy, selling this is easy, convincing you of the importance of all this is easy. When I talk about trader behavior, half the time traders, they zone out and they don't understand what I'm talking about. But the very few that pay attention and realize the importance of trader behavior are never going back to these stupid price patterns. It may be working for you. I'm not saying that this don't work. Or some of the experienced traders who swear by price patterns that yeah, these are the only things work. Why? Because they have the requisite experience. I'm not talking about experienced traders. I'm not talking about people who have proven their track record by making money in public space. I'm not talking about all those, because they already have the experience. I am talking about beginners, people who are new to the markets. They are not at the same position. You guys, if you are 1 year, 2 year, 3 year into the markets and you are trying to learn market profile, obviously you are not at a same place with market profile as me or some other trader who's using it for, say, in my case, more than 2 decades. In case of Jim Dalton, he is trading for a number of years which is more than my total age. So like, I don't consider myself to be even close to Jim Dalton. So you can learn, but it will take time. And if you focus on trader behavior, your learning will skyrocket and accelerate like never before. If you keep doing this and keep struggling with your trading, learning becomes very, very easy. And one more very, very important thing is, like, once these patterns they get stuck in your mind, it's very difficult to get unstuck, what I call unlearning. So be very careful what you are putting in your mind, especially in relation to trading. Okay, identify your competition. So this is what I was saying when I was talking about time frames. Who are you competing against? Let's say there is a smart money trader, a hedge funds, and he has a plan and he's doing something, and you are fighting against this. We are retail traders, right? Can you actually win against smart money? There is only one situation where you can win against smart money, and that is just via luck. There is no other way. So if you cannot win against smart money, if you cannot win against the competition, how can you expect to make money in the markets, and that too consistently? Is by joining your competition. So we know, right, that smart money is always going to be 1, 2, 3, 4, 5 steps ahead of us. What we can do is we can try to be 2 steps behind the smart money, 1 step behind the smart money. If you are 1 step behind the smart money, I need to learn from you. If you are 2, 3, 4, 5 steps behind the smart money, contrary to popular belief, you can make incredible amount of money in the market. So I'm not saying that you will be doubling your capital every week. That is stupid. What I'm saying is you can aim for a reasonable rate of return, have a nice framework to guide you on every step, have a nice trading process, follow it, and you can keep making this reasonable rate of return till you stop trading. Makes sense? So you need to identify the competition. Now, why I'm saying that you can be 2, 3, 4, 5 steps behind and still, uh, be a great player. Sorry, a great trader. I wanted to give you a cricket example. That's why I said player. Anyways, so everyone knows about Sachin, right? Everyone knows about Kohli. Now, there were many great players in between. We know these two because their records are the highest. There was Sehwag, right? And so many international players tried to emulate Sachin. In today's age, so many youngsters are trying to copy Virat Kohli. Now, can you say Sehwag was as great as Sachin? No. But I remember when I was watching those cricket matches, I used to get confused whether a particular shot was hit by Sachin or Sehwag when they both used to open. And that confusion used to happen so often. Why? Because Sehwag was trying to copy Sachin. Now, was Sehwag at the level of Sachin? No. But can we say Sehwag was, let's say, 2 steps behind Sachin? Yes. And if you look at the record of Virendra Sehwag, it is stupendous. Not as great as Sachin, but in itself, Sehwag has always been a respected and a great batsman. Look at Kohli. What is he trying to do? He learned so many things from Sachin. He learned something from Sehwag. He learned something from Dravid and all other great players that we have seen so far. And what he's doing now, he is setting an example. Now you look at Shubman Gill or Jaiswal and all the youngsters that are now following Sachin, trying to become good batsmen. So what I'm saying is, if you want to be a Sachin Tendulkar or Virat Kohli or a Warren Buffett or a George Soros, uh, going to be difficult, at least with the kind of capital we have. But we can learn how these guys, these greats of all the fields, they behave and how they trade or how they play cricket or whatever, and we can try to get close to them, and that will give us incredible success. All right. Then I use market profile to make correct assessment of risk present in the markets. So we'll look at it a little later. So risk assessment is very, very important. Half the traders are looking for a good entry, half the traders are looking for timing their trades. No one is talking about risk. For them, stop loss is the only definition of risk. Not true. And I'll tell you what exactly assessment of risk means going forward. Then I use it to develop trade ideas, because see, if I do not enter into a trade, how will I make money? How will I know that I'm right or wrong? So I have to enter into a trade, but before I enter into a trade or execute a trade, I need to develop the trade idea. That again depends on my time frame. So if I'm developing a trade idea on a market profile chart, most likely my time frame is short swing. That is 3-4 days I'm going to hold my trade. And then I can drop down to lower time frame to execute my trade. For lower time frames, I use VSA. On the other hand, if I want to trade from a higher time frame, say I want to trade from long swing time frame, I believe that, let's say, after a particular event, market is going to go in a certain direction for a while, I want to capitalize on that, I can execute my trades using market profile, which I have developed on higher time frames. Again, for higher time frames, you can use VSA. So I look at a weekly chart, I develop a trade, I look at daily chart, I wait for right moment or when everything is setting up correctly, and then I execute my trades on market profile chart by finding the lowest risk entry so that my initial risk is low. I can do that also. So market profile can help you do both things depending on your time frame. Now, obviously, so many things I just showed you on this previous slide. This is not even the complete risk that that the things list of things that I can do using market profile. There are so many things, right? But already the list is quite extensive, and again it won't be possible for me to cover everything, right? So I am going to look at a few topics from the above list to give you an idea, a glimpse into this world of market profile, right? Okay, so and I would like to highlight the fact that the actual CTF courses that I share, right, they are much more extensive, and it's just a small list of topics from all the things that are covered in this CTF courses. And now the CTF courses also is available in 2 flavors. So I don't want to sound like a sales pitch, but I have one that is covering core principles, and I have one that focuses on application of all these core principles to real-time market, real-world scenarios. So now we have 2 flavors in the complete trading framework course, and it's incredibly helpful. But coming back to today's session, what are we going to look at then? We are going to look at improving our market understanding, monitor trader behavior. This is a 5-star concept, guys. If you can pick this up and get it into your day-to-day behavior, make a habit of monitoring trader behavior rather than looking at price patterns, you will change your trading forever and for better. All right, I'm not saying that you will change it forever and never come back to trading. I'm not saying that. And how to assess the risk correctly. Okay, so let us look at these 3 topics one by one. Why improve market understanding? So I am saying that you want to improve the market understanding, but why is there an objective reason for improving the market understanding? And absolutely there is, and that is to crack this profitability equation. This is a concept that I have shared. It came to my mind, so I never found it anywhere else, and I've been sharing it for a long time now, like over a decade now. What is a profitability equation? It's very simple. Step 1, you improve your market understanding. Nothing moves before that. Then you move on to step 2, where because of this improved market understanding, your trading decisions will improve. Now, am I saying that you will always be able to enter at the perfect place and exit at? No. I'm not saying there is perfection or accuracy. I'm not talking about all that. What am I saying is that you will be able to differentiate between good market conditions, bad market conditions. And it is not a differentiation between trending and sideways market conditions, because using CTF you can easily trade sideways markets brilliantly. There is no issue with that. But is this market a good market which you should trade? Or within a day, are we at a good time to trade? Is the market development supporting a trade idea? All those things you will be able to do, and all those things is what I'm calling better trading decisions. Once you start making better trading decisions, you will start reducing your trading mistakes. Now, if you have all the records of your trades, let's say for last 1 year or 6 months or whatever, take all those records out, right? And hopefully you are journaling your trades. Start journaling your trades. Once you have that record and you have like entered reasons for entry and what went wrong and maybe a short analysis of that trade once the market closes, if you have a detailed journal, it's going to help you immensely. Because the one thing I just want you to look at, one thing: how many of your recent trades were mistakes that you realized after the fact? So obviously when you are taking a trade, it's never a mistake, because then why would you take it, right? If it's a mistake, why would you enter into that trade? You don't know that. But then the trade does not work, and when you look at it in hindsight, what you realize, oh, this is one factor that I overlooked, or this indicator was not giving me a signal, or there was a conflict, or this and that, and there was a news and whatever. It ends up being a mistake, because if only you had considered all the information points, you would not have taken that trade, and you could have saved yourself some losses. Now, once you start making better trading decisions because your market understanding is good, your trading mistakes will go down. And the first signal of trading mistakes going down is number of trades. So many of my core subscribers or people who are trading with me or who are with me for a long period of time, so many of them, I'm by so many, I'm saying like about 90% of them have confirmed this behavior. They say, Dean, we were doing this, we were doing that, we were making money, losing money, break even, I have blown my accounts, everything. They come to complete trading framework. What happens? They start using market profile, they start improving their market understanding. What happens? Their trading decisions improve, and the first signal they get is their number of trades go way down, way down. Like if they were taking say 40, I have person who was taking 40 trades in a week, he was not even able to take two, and out of those two, one was a scratch and one was a profit making trade, and he was incredibly happy because 40 trades, profit, losses, break even, this that mistakes, it was so difficult for him to maintain peace of mind. When he just took two trades, he was incredibly happy and he made money at the end of the week. So this is the first benefit. This is the first indication. Your mistakes will go down. Once your mistakes start go down and you start taking only good trades, your overall profitability will increase. I am not promising you 2x returns, 3x returns, you'll make 1 crore, 2 crore, screenshots, trading records, nothing of that. What I'm promising is that your overall profitability will go higher. That means here and there you will make losses, your overall number of trades will go down, you will only take good trades, and out of those good trades, obviously some will not make you money, some will maybe make you lose some money, but overall on balance you will start remaining positive, start improving your trading. That is the benefit of improving your market understanding, because this profitability equation you will be able to crack. Once you improve your overall profitability, your confidence in yourself increases, your confidence in your method increases. That leads to even better market understanding, and this cycle continues. This is what I call as virtuous spiral. Now we all have heard about vicious circle, where you get stuck in a circle and you cannot get out of your bad habits. This is a two-dimensional, like if you're looking at it from the top, it will look like this, but it is a virtuous spiral. Your understanding is limited at the moment, but first iteration of CTF, it increases, second iteration increases, and it goes on increasing, and it also takes up your profitability with that, and everything just simply becomes more and more enjoyable and profitable. Okay. And never forget, whenever I'm saying profitable, I'm always talking about reasonable rate of return. Okay, fine. Move on. Benefits of market understanding. Okay, why market does what it does, you will be able to answer this. Now so many times traders are not frustrated with losses. Please understand, they are not frustrated with losses. What they are frustrated with is the fact that they cannot answer the question, why the hell did I lose money? Why the trade did not work out? What was the reason? Because you tell me, you as a kid, every one of us have made mistakes. So touch something that was really hot, or did something that was dangerous for us. So I have done those mistakes, right? So if I have touched something that was really hot, like a iron, you iron your clothes, and when I was young, I touched one, and it burned my hand badly. So what did I learn from that experience? Is that the iron that you use to iron your clothes, it does not look hot. If you look at it, it does not look hot, especially the electric irons that we use. You have no way of telling whether it's hot or cold. But when I touched it and my hand got burned, now from that day, I was very young, but from that day onwards, I have been extra careful whenever I'm ironing my clothes or using that particular instrument. What did I learn? That if it is hot, it will burn you. If it is not, it won't. But why take the risk? So I learned why my hand got burnt, because it was really hot. So if you take a trade and it does not work out, can you tell with your current system? I'm not saying that, okay, there was no signal on this and that. No, the actual trader behavior that resulted in that loss. What was your behavior? Who were your competitors and what was their behavior? Can you tell and answer all these questions? If you can, then you know the answer to the question what market does, oh sorry, why market does what it does. Why is extremely important. We have CTF market logic for that. What is market doing right now? If you don't know what the market is doing right now, will you be able to find out what the market is likely to do going in the future? I'm not trying to predict the markets, but let's say there is a resistance, market goes there, expectation is it will get rejected quickly, but instead of getting rejected, it is moving sideways. What is this? This is classic absorption of supply covered in market profile. If this is happening, the likely behavior is actually a breakout. You can know before this big move happens that likely absorption of supply is happening. Can you do that with your current method? Most of the times people will trade in what? Anticipation. This is a resistance, it is going to hold, so let me put a limit sell order here. What happens? A market does not go down, move sideways and then breaks out and your stop loss is hit. You are trying to get ahead of the markets. Don't do that. Does your framework system tell you that? What has the market done in recent past? Context, which I keep talking about a million times in every session. Do you know what the market has done in recent, sorry, past? Where the market is trying to go? Can you tell an answer to that? But everyone is trying to find that out. You say you want to buy and you are predicting the market is going higher and then you will sell. But forget about predicting. Right now, if you look at the markets, can you tell where it is trying to go? High, low, sideways, whatever? Do you have an objective method of identifying that? We have the whole market development, trade development process to answer that question. And if at all you can answer like, okay, Dean market is going higher, I know that. Why? Because it is, let's say, about 20-day moving average, something of that system you're using, whatever, or there is a trend line or whatever. Can you tell me very clearly, is it doing a good job? Is it doing a good job? And if it is not doing a good job, then is it a good idea that you should buy just because market is going up? No. You need to find out low risk entries. Okay, you do that also. Where can the market go next? 90% of traders leave money on the table. That means they make some paper profits and their paper profits vanish. Why? Because they don't have any way of telling where they should book their profit. So what they do, they use arbitrary 2:1, 3:1 reward to risk ratio trades. They try to make twice their risk, thrice their risk on every trade. Is market stupid to give you your profits every time? No. And if it was giving you profits, why the hell are you here? Or why the hell this whole retail trading community is struggling? Because we don't know where to exit, how to exit. We use one reference at a time method for that. Where can I enter the market? Everyone is trying to time the markets. Whenever I have shared these intraday trading guidelines for free on my YouTube channel, for free. And if people are coming to me, staying with me for 1 2 3 4 5 6 months and joining my courses and my monthly workshops and everything, and I'm also teaching them the same thing, then why people who watch my free YouTube videos are not able to make money? And why, people who are in my courses, they swear by these intraday trading guidelines? What is the difference? Is the level of understanding of the concept. Is that level of understanding which is going to change your trading forever. And we have so many tools, but I can give you all the tools for free. It's not going to help. Why? Because you need to improve your market understanding. Once you improve that, you will be able to answer all the above questions that we just saw. Imagine if you could answer all the above questions, what will happen? You will be able to avoid bad trades. That is the number one problem. All right. You will be able to reduce your trading mistakes. Always remember, mistakes not only take away your money, but they take away your confidence. Now, if you lose, let's say 1,000 rupees, and you lose, say, X amount of confidence. Let me put a number on this. Let's say you are 100% confident, you lose 1,000 rupees, and your confidence goes down by, let's say, 5%. You are now only 95% confident. You take next trade and you win back your 1,000 rupees. Do you think you are recovering all your confidence? No. At max, you are recovering 1% of this confidence. So earlier you were only 95% confident. Now you are not 100% confident. You are only 96% confident. But you have made your money back. Then you may ask, Dean, but then I have made my money back. I have made all the profits back, all the losses I have recovered. Then why my confidence is not increasing? That is the human psychology for you. The painful experiences stay there. And you're not losing money, or you're not a bad trader because you made losses or you could not make your money back. It's because of this confidence deficit that you accumulate. Imagine doing this for year in year out and sitting at a 30% confidence level, 10% confidence level. What bad situation you have put yourself in if you are doing this again and again, and no way to recover your confidence. I'll give you an insight. How do you gain your confidence back? It's not by making money, forget about it. It's by catching a mistake before you make it. I haven't seen anyone talk about this ever anywhere. This is all I have learned from my own experience, trial and error. Catch yourself before you make a mistake, and then tell me whether your confidence increases or not. You will be able to stay calm and collected during volatile market situations, no matter whether we have election results, RBI policy, anything. I'm not saying you'll be able to trade the markets exactly, but you'll be able to stay calm and avoid impulsive trades. That alone will add so many percentage points to your bottom line. You will be able to find low risk trading opportunities. See, trading opportunities anyone can find. Even if you toss a coin, there is a 50% chance you will make money. Then why 60% is so much better than 50, or 70% is so much better than 50? It's all coming down to risk, initial risk, and you'll be able to do that very, very clearly. You will be able to manage your risks correctly. That is why all this talk about market understanding is so important. And I haven't found any other tool than market profile that will help you improve your market understanding. Trust me, I'm not joking here. Above all of the benefits that you will get from trading with market profile, the one thing that you will never want to give back, it's not your profits, it's your peace of mind. I have people praising me for giving them peace of mind. They don't even talk about what they're doing with their trading, because obviously if they are losing money, why would they say all these things? They will be making money, but they now understand where they should focus, right? And to help you understand all this, we use this another proprietary concept called as trader development spectrum. So why this is important is, you start as an absolute beginner, and 105 out of 100 cases, if you're just a beginner and don't learn properly, you will get into this bad stage where you'll be blowing your accounts or you'll be bleeding capital. So an absolute beginner learns something on the internet, feels he's the king of the world, starts trading, blows his first account, then improves a little and starts losing less money, then finds something, CTF, market profile, VSA, starts becoming a break-even trader, starts improving. Then he starts making consistent profitability. Then he's looking to scale his capital, improve his profitability. And finally, he becomes a consistently profitable trader where he just want to maintain the beautiful performance and become extremely rich and wealthy. One big problem is that even a beginner wants to become a consistently profitable trader. He's jumping how many steps? 1, 2, 3, 4, 5, 6. How many steps? He's jumping multiple steps. If you are in the first standard and you are bright, do your parents straight away put you into a medical college? No. They keep saying, they keep hammering your mind with, oh, my son is going to become a doctor, my daughter will become an engineer, whatever. They'll keep hammering because they want you to become an engineer or a doctor. But they're not going to put you in a medical or engineering college straight away in your second grade. No. So why then, if you're an absolute beginner or anywhere in the intermediate stage, you want to jump steps? You don't go from first standard to fifth standard, then directly to medical college. No, you don't do that. You go step by step. And the same thing you have to practice here. The only difference is if you have a good framework, good mentor, good people all around you, then this progress becomes accelerated. So I can say it took me 2 decades to become a consistently profitable trader. I'm not going to make you spend 20 years of your life to learn all this. I'll accelerate this process for you. Now we come to the second thing that you can do with market profile is monitor trader behavior. You have to combine market profile with innovation adoption curve. This is that S curve that we talk about. S curve is simply, it looks like an S. Now let's say the market is coming down, it consolidates, starts going higher, goes higher nicely and again consolidates, and now you are at a point where you want to find out whether it's going up or whether it's going down. What you need to understand is during this particular S curve which starts here and ends here, who are all the different people who were trading and what they were trying to do, right? Let us discuss. So when the market was going down and it was about to end its down move, we don't know whether it's going to end or not, but the smart money knows. What do you think the smart money was doing here as opposed to here? Here the smart money was definitely selling and here the smart money was buying. What the retail traders were doing, they were in denial this whole move down, and when it becomes completely unbearable, they are selling. So the retail is selling. Who is buying from them? Smart money. Here, when the market was up and giving you a pullback, what the retail was doing, they were trying to buy the pullback. Did they know it was going to turn down? No. Smart money was doing what? They were selling. And the retail keeps getting trapped. But traders who understand the markets, what they will do, they will wait for the market to confirm a reversal and then join somewhere here so that they can make some high probability profits. And they're not going to wait for it to turn down. They will get out at their predetermined trade management plan exits. This is the innovation adoption curve, which tells you whether you are trading against smart money or retail traders. Now, when the market is just recovering, who is selling here? Obviously, retail traders, because they have the fresh memory of the trend, and this is just a pullback. And now imagine if you are buying here, who are you trading against? You are trading against retail traders. So even if you are a retail trader, you are now behaving like a smart money retail trader, trading against amateur money retail traders. And what will be the outcome? You'll make money. That is the importance of this S curve, and we combine market profile with this so that you can find out different stages of that S curve and decide what you're going to do. We will look for signs of good versus bad trade facilitation. So we'll look at things like range extensions, single prints, one time framing, elongated profiles, higher value area placements, all the things that we talk daily in our weekly mastermind, which is a monthly workshop. We talk about it daily. The next batch is starting on 3rd June. We talk about this daily. We come to the markets, we analyze the markets, and these are the only things I am talking about. Why? Because these are the only things that are going to help you. Not only that, we talk about the other side. So if there are range extensions, okay, it is good, but if there are not inside bars, it is bad. So we warn about that. Single prints, market will continue. Sideways development, market will consolidate. One time framing, great for signs of new business coming in. Exhaustion, signs of buyers getting exhausted. Time frame shifting is happening. Inventory shifting is happening. Elongated profiles, good for continuation. D-shaped profiles, not good for continuation. You can even trade these. Higher value area placements, higher time frame trend. Higher time frame consolidation will show you sideways value area placement. Now, I can give you all these things today. Do you think from tomorrow you'll be able to make money? No. Why? Because you have to put all this in a cohesive framework, right? And let's say BellTPO announces that from tomorrow for 1 year, everyone who comes to them will get market profile software for free. Just getting the tool is not going to help you, or just learning the concepts is not going to help you. When you combine the correct concepts, the correct understanding with the correct tool is where the magic happens. That is the reason why I have such a long standing business. I won't call it a business. I have a friendship with Vinod, who has been tirelessly bringing these wonderful tools to you at extremely affordable rates, right? Then we come to the third topic, which is correct risk assessment. If you cannot assess the risk, you can enter at the perfect time and exit at the perfect time, but still won't make money. It may sound a little funny, but that is true. What is the traditional view of looking at risk? Diversify your portfolio. If you come to me, what I tell you, look at one stock, one index, one. I talk about one. People argue, push back. I say, okay, two. That's it, not more than that. They say, no, please do something more. Then I say three. But I say you trade only two of them. You can monitor three. Now, if you're trading three or more stocks, if you have a watch list, congratulations, you're on the other side of the table, and smart money will keep taking money from you. Second thing is, every other mentor will tell you to do what? Put a stop loss. Do you think I trade without a stop loss? Absolutely not. I also put a stop loss. What is the difference? The difference is not where you put a stop loss. Difference is knowing why you should put a stop loss at a particular uh, level. Why here? Why only here? Or are there some levels beyond which if you put your stop loss, the chances of getting your stop loss hit is much less? Absolutely. Then they tell you risk only 1 to 2% per trade. We have a concept called as product controlled. And when people learn about this, they get that light bulb moment that, oh, if only I use this method to manage my risk, I would never overtrade in my life. Never. And whatever happens in my trading, I won't threaten my account, blowing up my account. Right? So what is a CTF view? Is we trade only one or two instruments at a time. We use the CRA framework, which is the continuous risk assessment framework, to identify risk of being long, short, or flat. People try to predict the market. then they put their stop loss, and they have no idea whether the market is currently in a risky situation. So let's say they have bought, they have no idea whether the risk of being long is high or low at this moment. If it is very risky being long, no matter how good a stop loss you place and how many percentage you risk per trade, it is going to get hit. Then we use one reference at a time, and market profile is the best tool to give you those references, very clear references, which you should use as targets. No other tool than market profile gives you pivots, support and resistance, and you bring whatever you want to bring. The only tool that gives you the best references, and please understand, with logic. What is the logic behind pivots? There is no logic. It is just some arithmetic. Market does not work on arithmetic. Otherwise, everyone would be incredibly rich. Market would have shut down long back. Why market is still continuing? Because it is run by traders. Traders are run by their what? Emotions. If traders are run by their emotions, do you think arithmetic will work? No. If it would work, then all the emotional issues that we all have as human beings would be completely solved. Why they are not solved? Because it is not a mechanical problem or a mathematical problem. It is a psychological problem that cannot be, broken down into numbers. So what you need to understand, trader behavior. For that, what you need the logic that traders use to trade in a particular way. It is a smart money logic. There is amateur money logic. If you're using this, you are struggling. If you're using this, you will be successful. Then we use last point of supply and demand concept to identify support and resistance correctly. Anyone can tell you this line is a resistance, and if it holds, he will shout from the rooftop that he has identified the correct resistance. But if you ask him what is the logic, not even 1% of so-called mentors can give you logic that you can easily understand for why a particular reference will work and will not work. And then we use a statistical concept called as expectation. This goes to the risk part, but it's very, very important. All right, and much more. All right. So you may say, Dean, where is market profile in this? Yeah, we did not go to a single market profile chart today, but why I'm doing this is because I'm setting you up for the upcoming session, the last session in this, which we are going to spend the whole session only on market profile charts. Now you might say that is like too much hard work. You took almost 2 sessions, 2 hours, 2 Saturdays from us, and you did not give us a single market profile chart. Trust me, when you come back in the next session and when we actually go to the charts, things will make sense. Otherwise, I can start teaching you market profile from the first day. Nothing will go in. Either you will take a decision that this thing is too complicated, I am not going to go for it, or a worse situation will develop where you use it incorrectly. Then it won't give you results, and then you will give up on market profile, and then you will start telling everyone that market profile is stupid, it does not work. Now, I don't care who calls market profile stupid or what other people think about market profile. I don't care about that, because I know what market profile actually is. But what I care about is you. Why? Because if you use it incorrectly, or if you give up on market profile just because it seems too complicated, then you will be losing out on a beautiful tool that has the power of changing the course of your trading career. It did that for me. I was using Elliott wave, I was using price action, I was doing all the things, indicators. You tell me a particular trading concept and I can guarantee that at some point in time in my trading career I pursued it. But when I came across market profile, things changed. They changed for better. And I'm not saying I immediately started making money, but my losses went down, my number of trades went down, my understanding improved. And when all those benefits they came to me, the only thing that came to my mind is let me share it with other struggling traders. I want them to become better at trading, to make it, to take the pain away out of that trading experience, to make it enjoyable. See, even if you make a small loss, your trading is not 100% game. You will always make some losses, make some profits. The goal is to be profitable on balance. Now, even if you make a loss, you will be put it in perspective. You'll be able to put it in perspective so that it's not taking away your confidence. Because I told you just a while ago, confidence deficit is almost impossible to recover. And I also gave you the secret how you will recover your confidence deficit. And all that can be done so beautifully using market profile. All right. So next session, we will look at what most traders are looking for: trade setups. Now, if some of you or maybe some new people will register and they come to the third session, they don't bother with the first two sessions, it is not going to help you. Now, some of you who have been here for 2 sessions and wondering why the hell are we here, or wondering when Dean will show us a market profile chart, that's going to happen next Saturday. And we are going to look at, I will show you exactly how I would like to enter or exit my trades. But all that will make sense when you have gone through the first 2 sessions and preferably through the complete trading framework. I will share with you how to develop a trade, how to find good entries, how to identify good targets, and how much to risk. Now, if there is anything else to trading, you please let me know, because I don't think there is. Now, you might say, but then what about trading psychology? Well, the method I'm using is based on trading psychology. I have, so many books. I have read hundreds, but I personally own so many books on trading psychology, how human brain works and how it works, especially in this very volatile business of trading. That when I'm answering all these questions for you, you rest assured that they are based on trading psychology, and they are not just repeatable patterns that are working in the current market situation and may not work going forward. It's not like that. It will change the way you look at markets. It's like learning to ride a bicycle. There is a correct way to do it, incorrect way to do it. Once you learn the correct way, do you do it incorrect way? No. Or maybe consider the example of swimming. You go inside with that lifesaver jacket and whatever that tube or that round tube that we use, and then there are coaches around you, and you're in a shallow water. If you stand, you are above the water. So why are you doing all that? Because you swimming can become really dangerous if you don't know how to do it correctly. But once you learn that, where is the fun? It's not in the shallow waters, it's in the deep waters. And when you go into deep waters after learning how to swim correctly, do you uh, go back to your old methods where you are not even able to stay afloat? No. Once you learn the correct way, will you go back? No. And this trading business is like that. If you learn the correct way of doing things, you will never go back. And especially if it is based on trader behavior, then even if the behavior changes, you will be able to pick it up using your framework, using the correct tools like market profile or VSA, and you will bring yourself back on the correct track. And all this, if it becomes a automatic process, part of your personality, then you tell me how enjoyable trading is going to be. I hope all that uh, makes sense to you, right? And I'm sure you can appreciate uh, the effort I'm putting in, and the I have gone through a lot of bad years, painful losses, and blown up accounts. So I don't want you to go through that pain again, and that is the reason why I'm sharing all this so passionately.